China's financial landscape is vast and formidable, resembling a slumbering dragon with scales made of shimmering gold. For years, this dragon has guarded a treasure trove of bonds, particularly government bonds, that have remained largely hidden from the outside world. Yet, whispers of their allure have begun to spread, attracting the attention of global investors seeking stability and attractive yields in an increasingly uncertain world. These bonds, denominated in yuan, represent a tantalizing opportunity for those willing to venture beyond familiar territory. Imagine a world where interest rates are dismally low, and finding a decent return on your investment feels like searching for a needle in a haystack. This is the reality for many international investors facing a global yield drought. In this parched environment, Chinese government bonds stand out like a verdant oasis, offering a refreshing stream of higher yields compared to their developed market counterparts. The sheer size of China's bond market, the second largest in the world, adds to its allure. This market, though still young and evolving, boasts remarkable depth and liquidity, particularly in the government bond segment. As China's economic might continues to grow, so too does the appeal of its bonds, drawing in foreign investors eager to tap into this dynamic and expanding market. This essay delves into the captivating world of Chinese bonds, exploring why they have become a significant player in global finance, despite China's stringent capital controls. We'll examine the factors driving their appeal, the mechanisms facilitating foreign investment, and the delicate balancing act between control and openness that defines China's approach to its financial markets. James Harrington, a seasoned portfolio manager based in London, found himself increasingly frustrated. Years of declining interest rates in developed markets had left him struggling to find investments that could generate meaningful returns for his clients. Traditional safe havens like U.S. Treasuries offered little solace, their yields hovering near historic lows. "It's a global yield dilemma," Harrington lamented to his colleague Dr. Sarah Chen, an economist specializing in China. "We need to diversify our portfolios, find assets that offer a better risk-reward profile." Dr. Chen, with a knowing smile, pointed towards the east. "Have you considered Chinese bonds, James? They offer significantly higher yields compared to their developed market peers, and their economic fundamentals remain strong." Harrington, initially hesitant, began to see the appeal. China's steady economic growth, coupled with its relatively low debt-to-GDP ratio, painted a picture of stability that was increasingly rare in the post-pandemic world. The prospect of earning a higher return while diversifying away from traditional markets was certainly enticing. He wasn't alone in his thinking. Global investors, starved for yield and seeking to reduce their exposure to volatile markets, were increasingly turning their attention towards China's bond market. This influx of foreign capital was a testament to the growing confidence in China's economic resilience and the allure of its bonds. However, accessing China's bond market wasn't as simple as hitting the buy button. China, for all its economic liberalization, has maintained a cautious approach to opening up its financial system. Strict capital controls, often referred to as the Great Wall of Capital, have acted as a barrier, regulating the flow of foreign investment into and out of the country. This cautious approach stems from China's desire to maintain financial stability and control over its currency, the yuan. The memory of the 1997 Asian financial crisis, where rapid capital flight wreaked havoc on regional economies, serves as a stark reminder of the potential risks associated with unfettered capital flows. Yet despite these controls, China recognizes the benefits of gradually integrating its financial markets with the rest of the world. Foreign investment brings in much-needed capital, promotes competition, and enhances the sophistication of its financial system. This delicate balancing act between control and openness has defined China's approach to financial liberalization. To navigate this intricate landscape, China has strategically implemented various mechanisms that provide controlled access for foreign investors to its bond market, carefully managing the influx of foreign capital while minimizing potential risks. Section 4. Bond Connect, bridging the gap for global investors. One such mechanism is the Bond Connect program, launched in 2017, which revolutionized foreign access to China's interbank bond market, the primary marketplace for trading Chinese bonds. Prior to Bond Connect, navigating this market was a complex and often opaque process, deterring many foreign investors. Bond Connect, however, streamlined the process, allowing investors to trade Chinese bonds directly through established trading platforms in Hong Kong, eliminating the need for cumbersome procedures and onshore trading accounts. This program effectively built a bridge between global investors and China's bond market, making it significantly easier for them to participate. The impact of Bond Connect was immediate and significant. Foreign holdings of Chinese bonds have surged since its launch, with investors drawn to the program's simplicity and efficiency. It has become the primary channel for foreign investment into China's bond market, further solidifying its position as a crucial link between China and the global financial system. The success of Bond Connect highlights China's commitment to gradually opening up its financial markets while maintaining a firm grip on the reins. It's a testament to China's ability to adapt and innovate, creating pathways for foreign participation while mitigating potential risks. Section 5. Index inclusion, propelling Chinese bonds onto the world stage. Another significant development that bolstered the prominence of Chinese bonds was their inclusion in major global bond indices, such as the Bloomberg Barclays Global Aggregate Index and the JP Morgan GBI-EM Global Diversified Index. This inclusion, which began in 2019, was a watershed moment, signaling China's arrival as a major player in the global bond market. Index inclusion carries immense weight in the investment world. Trillions of dollars are passively managed in funds that track these global indices, meaning that any country or asset added to these benchmarks automatically attracts significant inflows from these funds. For Chinese bonds, index inclusion was akin to being placed on a global pedestal, shining a spotlight on their attractiveness to a wider audience of international investors. Passive investors, obligated to track these indices, were now compelled to allocate a portion of their portfolios to Chinese bonds, further driving up demand and liquidity in the market. This inclusion served as a resounding vote of confidence in the credibility and investability of China's bond market, solidifying its position as an increasingly indispensable component of a well-diversified global portfolio. Section 6. The paradox of control, finding comfort in regulation. The growing appeal of Chinese bonds presents a compelling paradox. Despite China's tight grip on capital flows and a complex regulatory environment that can often seem opaque to outsiders, foreign investors find a certain level of comfort in this controlled approach. Paradoxically, China's strict regulations and capital controls, while seemingly restrictive, contribute to the stability of its financial system. This stability, particularly attractive in an increasingly uncertain world, provides a sense of security for investors seeking a safe haven for their capital. Furthermore, China's government, with its strong command over the economy, has demonstrated its ability to effectively manage economic shocks and maintain a relatively stable trajectory. This proactive approach to economic management instills confidence in investors, assuring them of the government's commitment to supporting growth and, by extension, the value of its bonds. This paradox highlights the unique dynamics of China's financial system. The government's firm hand, while potentially deterring some investors, provides a sense of predictability and stability that is highly valued in today's turbulent world.